Welcome, ladies and gentlemen. My name is Brad Matheny. Today is the 19th of August. I have been under the weather for the past couple of weeks. I won't go into too much details, just suffice it to say that I pushed myself pretty hard trying to take care of things and really kind of ran myself down. So yesterday and today are the first days that I'm really starting to feel somewhat human again. Got to take care of myself, and it's a reminder for everybody. These crazy times in the markets, we just got to really slow down and make sure that we're watching out for us, okay? It's very, very important. Okay, so now, this last week, a lot of interesting things took place with China extending their credit crisis, with the some of the largest developers now moving into bankruptcy. I talked about this many months ago, actually more than 3 years ago, how I thought the U.S. would not be the center for the next crisis. I thought it would come from China and Asia. I thought it would be an extended contraction in the economy. I really do believe that the excesses that have taken place in the growth of the Asian market since the, call it, mid-90s until now has created an extended decline function that nobody's really prepared for. Is it going to be a crash? Well, it could be in certain areas, in certain sectors, particularly in Asia. Remember, Asia is somewhat immune from spilling into the U.S. because even if apartments in Asia drop 40%, it's not going to really affect us here. But we are going to have issues with supply side potentially again. Supply for chips, supply for materials, supply for consumer basics, things of this nature may become a bit more of an issue. So we're going to look at this chart here. This is what I call my smart money chart for the SPY. We actually have the SPY right up here. We've rolled over and rolled downward. This is a weekly chart. But what's important for you to understand here is this rotation of, and I'll explain it to you, volatility down here, trending, volatility, trending, volatility, trending, volatility, trending. So if we read through this and you take a quick little look, you can see here we go into a volatility period. It lines up perfectly with the volatility period here. Then we move into trending. As we move into trending, we would want to see, is it breaking lows or taking out highs? It's taking out highs. Okay. Then we roll from a peak here back down into volatility. Okay, we go back to volatility. There we go. Now we move back into trending. Then we move into moderate volatility, and then back into trending. Then moderate volatility, then back into trending. Look at how the trending has taken place here. And again, this is what we're looking for in these trending systems. So where we're at currently in the grand scheme of things here is we're moving down into a volatility event right over here. You can see it right here. We moved into one right here, then we moved into trending, and you can see the trending channel here took place. Now we're moving into a deep, deep volatility event. We could continue to stay in this volatility event for maybe 2, 3, 4 weeks, kind of like we did over here, before we move into trending. And trending may be an up or down type of scenario. I do believe that we are targeting this 404, 405 area on the SPY. I think this is going to be ultimately where we're going to try to find support, which means we're more than likely going to be seeing some sort of a downward trend channel like this, that takes place and moves us into kind of a downward flagging channel. That would be a very interesting scenario to do something like this, stay around this 404 area, and then move into some sort of a new trend. That I could see happening very, very easily. And that would mean that we would move into kind of an extended consolidation down here, and then move into some trending, and then we'd move back into consolidation back here, and then move back into trending here. So that's where we're looking at right now with regards to the smart money index. When we come back over here and we take a look at the US to global index, I got to get this spread out a little bit so the lines line up. You can see here that we have now moved into a downward cycle trend right here. We've moved into a downward cycle trend off of this level here. This is an indication that the global markets and the U.S. markets are weakening considerably. We could, ladies and gentlemen, we could attempt to move downward and attempt to retest these areas here, as I mentioned to you earlier. We could attempt here to move back down and retest these areas here globally. So understand that we are now in a consolidated sideways channel, more than likely moving into some sort of a flagging formation on the SPY. Whoop. Do it this way. Some kind of a flagging formation like this, and across here. And then we will likely move into some extended trending back over here where I mentioned in 2025, 2026. Excuse me. This chart gives us a much better example of what I actually think is going to happen. This is my NDX at the top, SPY in the middle, and this is my custom Fed funds rate. So you can see the Fed funds rate right now had moved higher and is actually kind of moving downward here. What this is telling us with this moving downward here is that it's putting pressure on the markets, okay? The U.S. Fed funds rate will probably stay elevated. The Fed will probably not blink. I'll bet you they raise at least one or two more times throughout this year, which could put quite a bit of pressure on the global markets. And I believe what's going to happen is we're going to see the U.S. markets, as I mentioned earlier, move down into this area, base, move back up into this area, peak, maybe not get to new highs, and then move back down into this area, which is going to be where we're going to be looking for some sort of a base leading into 2025 for a new rally phase here. And this all goes back many months. You can see I've drawn this over and over again. I expected it to peak here and roll down, giving us these two windows of opportunity here. Didn't happen. Now we're in a late stage rollover. It's going to likely move down, find support in here, 400, 405, roll back up, stall out, roll back down, retest the 408, 410 area, and then start to move higher back here to the upside. The Fed funds rate is not really affecting the market, but understand that globally, when consumers start to pull back, like we're going to see in China, and we're going to see elsewhere in Europe, particularly in regards to earnings and workforce participation and consumer general spending, this is going to keep the markets tagged in the U.S. markets in a very tight channel. We got to look for our opportunities when they show up and stay very, very cautious of trying to get married into big trends, okay? All right, so now let's, what else did I want to show you? Let me see this. Yeah, okay, I can show you this. This is the fear cycle index. And so the fear cycle index has moved back up. We could be looking at a moderate volatility event over the next 5-6 weeks. This could push the SPY down to the 404 area down here. This is the U.S. sentiment index moving downward. I believe this is going to continue to unwind probably until, I'm going to guess, October, maybe. So we're going to be looking at a downward trend into this area, another 6, 8, 10 weeks out. And I believe that we're going to see the fear index move a bit higher. Now, remember, this credit event is not going to come in, like the global financial crisis and wipe out banks right now. It could over 6 weeks or 8 weeks. But this right now is very isolated. We'll see what happens. We'll see how much contagion there is in the U.S. market and the European market. But right now, it doesn't look like there's a whole lot of spillover taking place, okay? Okay. So now let me come back over here to the watch list. What I was looking here, this is a weekly watch list, the TT scanner. I was looking for sectors that are holding up in strength, generating any buy or sell triggers. This is weekly again. telling us that, okay, this is where the markets are going. We have an opportunity here, or we don't have an opportunity there. And to be honest with you folks, we're not seeing a whole lot of strength in this market. We're getting warnings, bearish, warnings, distribution. We're getting a couple of bullish triggers, a couple of bearish triggers. We're getting some 33 thrust patterns here. We got a pop shift pattern right here in the internet, Dow Jones Internet. But we're pretty well flat, okay? So there's not a lot of opportunity here for us to move into daily, weekly swing type trading. I'm certain there's going to be individual sectors and individual stocks that are going to be performing fairly well. But again, we're not seeing a whole lot of broad-based participation, and it really comes back down to the fact that we're in this sideways channel. So again, when you come and you take a look at where we're at with this move, we've come all the way up, we've come back down, we've rolled over, we've moved back downward here. We're pretty much in this sideways channel, probably near a 618 pullback from these lows here, indicating that, you know, we're not seeing any real strength, we're not seeing any real weakness yet. We're in a sideways channel, which is pretty much telling us at this point we need to be cautious, we need to wait, and we need to look for opportunities. If we're going to take any trades, we need to be moderately cautious with how we handle our trading capital. Now, I wanted to talk to you about crude oil. Crude oil will, in my opinion, attempt to move down below this $63 to $65 area, simply because if consumers react the way they normally do to a crisis event, like we saw here with COVID, this is a crisis event. We saw the same thing back over here when we had the 2008 and 9 collapse. You see consumers really pull away from demand for oil. That includes, driving all over the place, spending money on travel, ordering all kinds of stuff. So we're going to see what happens here, but I do believe that oil is going to make a very sharp move down into this 62, maybe $50 area, try to consolidate, and then maybe come up a bit and build some momentum out of this into 2025, 2026. Be aware, this move could actually get quite a bit deeper. We could get down into the 20s, 30s area, kind of like we had back here, or back over here into really deep territory. So we need to be aware that crude oil is going to have an issue, in my opinion, just simply because that's what happens when we have these contagion events. And gold and silver are doing what gold and silver do, which is they are reacting to the crisis event by pulling downward. I got a lot of stuff on here. I'll try to spread it out for you. We are pulling downward in a tight upper channel right over here. We're holding up above the 1890 to 1920 area, which is our key support. We are attempting to move up into this breakaway phase. So understand that we are going to be attempting to make a move up into this area over the next 6, 8, 10 months. Then we are going to make another move up higher into this expansion channel over here. But right now we're getting the same type of a downward blip like we had back over here in COVID. Right here, we get this little fear blip. And that's what's happened back over here. We get this little fear blip. Now this is monthly, so let me come into weekly and spread this out. Here we go. So here's our little fear blip. You got 3 weeks of downward trending because of what's going on in the market, the rollover. We're holding up above this nice support level, 1919 roughly, 1920. We could come down here and tag this low level here, right here at 1830, 1840. But ideally what's happening with gold right now is we're getting this downside. Everybody's kind of ignoring it. Then we're going to get this move back to the upside, and then eventually it's going to move up into new highs above 2250, 2350. So be prepared. This credit event is actually very, very healthy. Okay, we need to wipe out some credit structures that are carrying debt And again, we could actually do this throughout the globe, including the U.S. We need to essentially shed debt that is counterproductive and slowing down our ability to actually grow. And that's something that's happened over the last 20 years, mostly in developing nations in Asia and Eurasia. And it's basically, that's what I've been warning all of you about prior to COVID. As we move through this, capital is going to shift. So as China contracts, India is probably going to get stronger. Other areas may end up getting stronger as well. But remember, the driving force right now are the strongest, most capable economies on the planet. And that's still the United States, in my opinion. Okay, guys, so we may have literally a 90-day window of kind of sitting patient, waiting for short-term trends in the market, not seeing any real leading sectors out of this yet. Okay, in the U.S. market, I still think that alternatives and innovation, possibly, and mid-cap, small-cap are probably going to do pretty well. But we're going to see how this plays out, because right now, if this contagion event turns sideways over the next 10 days or so, we're going to see a much deeper decline, and that's going to see some real big unwinding across the globe and across asset prices. So we need to kind of just be cautious, set your stops, don't get overly married to a position, and let's wait this out a little bit before we start looking for new positions. Okay, guys, talk to you soon.